At first glance, it might seem like not much is happening in the world of crypto. Prices are steady, volatility is low, and headlines have moved on. But beneath that surface, the conditions for a major shift are already forming, and if you're only watching the charts, you'll definitely miss out. The Fed just delayed its rate cut plans. Inflation's proving stickier than expected, and the bond market is under historic pressure. The pressure's already bleeding into the system. You just won't catch it if you're only tracking price action. My name is Danilo, and today I'm breaking down what's really happening behind the scenes, how these shifts are setting the stage for the next crypto rotation, and what you can do right now to be ready before the market wakes up. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. The Federal Reserve held interest rates steady again, just like the market expected. But this wasn't a soft pause, it was a shift in tone. The Fed is signaling that rate cuts might not come at all this year, and that has big implications for anyone hoping for liquidity to fuel the next altcoin cycle. Just a few months ago, most analysts expected at least 2 cuts in 2025. Now, only one is likely, and here's the key part. 7 out of 19 Fed officials now believe we won't see any cuts until 2026. That's nearly half the voting committee. This matters because rate cuts typically drive money back into risk assets, things like tech stocks, crypto, and low-cap tokens. Without them, capital stays cautious. That means less money flowing into altcoins, slower volume on DEXs, and fewer catalysts for breakout trades. For crypto, this is especially relevant because the longer rates stay high, the harder it is for new money to enter the market. It doesn't mean Bitcoin or ETH can't move. It just means you're less likely to see the kind of parabolic risk-on environment that many traders are used to. The Fed didn't pause because they're confident inflation is under control. They paused because the risk of it returning is still very real, and all the pressure points remain in play. Despite all the talk of soft landings and disinflation, the reality is far more stubborn. Inflation isn't accelerating, but it's not easing either. It's stuck. And that's a problem, because the longer it stays sticky, the less flexibility the Fed has to lower rates. The latest CPI print came in slightly below expectations, but core inflation, which is what the Fed actually watches, is still hovering well above the 2% target. And when you zoom into services, housing, and wage growth, there's no clear sign of relief. In fact, rent inflation is starting to tick back up, which puts even more pressure on the numbers in the months ahead. So why does this matter for crypto? Because sticky inflation keeps liquidity tight, and in this market, liquidity drives everything. When rates are high and inflation isn't budging, capital flows slow down. Risk appetite shrinks, and altcoins, especially the low caps, get hit the hardest. A lot of traders are waiting for a clear signal that inflation is quote done before they rotate back in. But what if that signal never comes? What if we stay stuck at 3 to 4% while rates remain elevated and markets drift? That's the scenario smart money is preparing for. Not a collapse, but a massive grind. And if you're positioned for fireworks while the market stays frozen, that mismatch can bleed your edge faster than you think. While most people are focused on stocks or inflation, there's something far more serious happening quietly in the background. The bond market is breaking. US Treasuries, which are usually seen as the safest investment in the world, have dropped by as much as 46% from their peak. That's the worst bond drawdown in over 250 years. Listen, to put that into perspective, imagine you bought a 10-year government bond paying 2% back in 2021. Today, with new bonds offering closer to 5%, yours is basically worthless by comparison, unless you're willing to sell at a steep discount. And that's exactly what's happening across the entire system. The problem is that banks, pension funds, and asset managers are sitting on trillions of these older, low-yielding bonds. They can't sell without locking in massive losses, and they can't just wait forever either. This is the same structural pressure that helped collapse Silicon Valley Bank. The only reason more dominoes haven't fallen yet is because regulators have let banks hold these losses off the books. Here's why this matters for crypto. The bond market isn't just another asset class, it's the foundation of global finance. When it starts showing signs of failure, it undermines trust in traditional systems. And that's exactly when Bitcoin starts to look more attractive. Not because it's perfectly stable, but because it's not dependent on a central bank, a yield curve, or a bailout. We're not quite there yet, but the cracks are showing. And smart investors are already watching this as a leading indicator. not just of recession risk, but of longer-term capital rotation into harder non-sovereign assets. So, if you're ignoring the bond market because it sounds boring, you're missing the clearest signal we've had in years that the legacy system is under stress. That stress doesn't always show up in the crypto charts right away, but when it does, it tends to move very fast. While everyone was watching rate decisions and inflation charts, something major happened in Washington. Stablecoin regulation finally moved forward. The US Senate just passed the Genius Act, a federal bill that lays the groundwork for how stablecoins can be legally issued, backed, and supervised in the United States. Right now, most large financial players avoid stablecoins like USDT and even sometimes USDC because of the legal gray area. But if this regulation passes the House and becomes law, it could unlock a wave of new capital. Capital that doesn't just sit on the sidelines, but actually flows into DeFi, tokenized treasuries, and eventually crypto-native assets. If you're someone who tracks stablecoin market caps, this is your heads up. A regulated stablecoin environment will likely trigger a reshuffling of liquidity. Projects that build around permission stablecoin rails will have an edge, and speculative flows could accelerate as risk appetite improves. This isn't a story that will move markets tomorrow, but it's one that can quietly set the stage for the next leg up, especially in a space where liquidity moves fast and narratives rotate overnight. The US dollar still dominates global trade and finance, but beneath that dominance, cracks are starting to form. Debt levels are exploding, interest payments on that debt are rising fast, and investors are starting to demand higher yields just to keep holding US bonds. That's the early stage of a confidence spiral. Here's how it works. As debt grows, the government has to issue more bonds to fund itself. But the more bonds it issues, the more investors worry about long-term inflation and repayment risk. So, they demand higher yields. But higher yields make the debt even more expensive to service. It's a loop with no clean exit. Keep in mind, this isn't some doomsday theory. Ray Dalio and others have laid it out clearly. The US is on an unsustainable fiscal path. And unless something big shifts, higher taxes, spending cuts, or rate suppression, the likely outcome is devaluation. Not overnight, but slowly and structurally. For crypto, this matters because Bitcoin was built as a direct response to this exact problem. When confidence in fiat weakens, capital starts looking for alternatives. Bitcoin isn't just a speculative asset, it's a monetary hedge that lives outside the traditional financial system. And that's why we've seen its correlation with gold strengthen during moments of macro stress. And it's not just Bitcoin. A weakening dollar narrative also creates room for stablecoin innovation, cross-border payment rails, and alternative stores of value on-chain. If the dollar's global role begins to erode, crypto is one of the few liquid, non-sovereign systems ready to absorb that shift. This isn't a short-term trade. It's a long-term shift in how capital allocates when trust in fiat starts to erode. And right now, the signs are showing up earlier than most people are starting to realize. Bitcoin's price action has been boring lately. Volatility is low, volume is down, and the charts haven't said much in weeks. But on-chain data tells a different story, because wallets tied to institutions, funds, and whales are quietly buying again. Addresses holding more than 10,000 Bitcoin have started accumulating for the first time since March. Coinbase outflows are ticking up, and ETF inflows, while not explosive, have been consistently positive, especially on red days. That's not retail chasing momentum, that's smart money buying into stagnation. Even if the charts feel dead, that kind of behavior doesn't just happen in a vacuum. These entities aren't timing perfect entries, they're positioning ahead of something. Maybe it's front-running a macro rotation. Maybe it's anticipation of fresh spot ETF approvals in other regions. Either way, they are moving. And this is where the opportunity lies. Retail usually shows up after the breakout, but the best setups often form when nothing looks exciting. Low volatility, flat price, no headlines. That's the zone where risk-reward quietly flips in your favor, if you're paying attention. So while everyone's waiting for a confirmation from a green candle, on-chain flows are already flashing signs of accumulation. The price hasn't moved yet, but the capital has. If you've watched this far, you're already ahead of most retail. The data is clear. The Fed is cautious, inflation isn't resolved, bonds are breaking, and capital is quietly rotating into hard assets. This isn't the moment to chase hype. It's the moment to position smartly before the next move. So, what should you do? First, zoom out. The big trades this cycle won't come from reacting to headlines. They'll come from understanding when the market is mispriced. Right now, crypto is acting like we're heading into a soft landing. But everything we just covered suggests the risk environment is way messier than that. Second, tighten your portfolio. If you're sitting in low liquidity meme coins hoping for a surprise pump, rethink your exposure. Smart money is rotating into Bitcoin, ETH, and liquid majors, assets that benefit first when capital flows back in. You can always rotate down the risk curve later, but front-running narrative starts with being in the right layer of the market. Third, follow the money. Stablecoin flows, ETF data, and on-chain movement tell you more than sentiment ever will. You don't have to time the bottom. You just need to avoid being late to the rotation. The truth is, the next breakout won't be about CPI prints or Powell pressers. It'll be about who was paying attention when the charts looked boring. That's your edge right now. So here's the takeaway. Bitcoin didn't stall because the opportunity is gone. It's flat because the market doesn't know how to price what's coming. And that uncertainty, that's where the edge is. While most people are waiting for a headline to tell them it's safe, the ones paying attention are already positioning, quietly, patiently, and with conviction. This cycle won't reward the loudest, it'll reward the earliest. The ones who zoomed out, saw through the noise, and acted when it still felt uncertain. So here's the question. With all the signs flashing beneath the surface, are you going to wait for confirmation or position ahead of the crowd? If this video helped you connect the dots, give it a like and drop your thoughts in the comments. And if you want more crypto breakdowns like this, hit subscribe and ring the bell so you never miss what's next. Thanks for watching, and I'll see you in the next one.